You could have made that argument, and I think we did, in fact, make that argument many times over the last 5 to 6 years because international and emerging markets were lagging. And it just felt like, based on statistics and what historically the markets have done over time, it has to revert at some point. The US has to stop outperforming. And it hasn't. It sort of started to in 2017. We had a year where international and emerging markets had a good year, but then the trade war, I think, sort of threw a wrench into that. Um, Part of the reason for that is I think there's just uncertainty with trade, and there was um, international markets slowed down, and in particular emerging markets led by China. There was just so much uncertainty last year that those markets kind of they sort of froze up in terms of investor flows. China's still growing, and even with the trade war, China was still growing substantially faster than the U.S. economy. Um, but overall, you can go back just about any time frame, and you see that U.S. has outperformed over the last year to date. U.S. is outperforming over the last 1 year, 3 years, 5 years, 10 years. U.S. is outperforming. In fact, if you go back 10 years, international and emerging markets have gone nowhere, just in terms of real returns to investors. A big part of that is due to currencies, and we're going to talk a little bit about that today, because the argument that I'm going to make is that the US dollar strength has been a huge reason for the outperformance of the US versus international, and in particular emerging markets. We don't try to make predictions here at our firm or on our webcast, but there's a good reason for that to potentially reverse. I think it's an opportunity to do, at the very least, some rebalancing. U.S. markets are at all-time highs, and just to spend 1 minute on that, um, people see headlines that Dow and S&P hit all-time highs, and for whatever reason, the interpretation of that is that it can't last, and that we're due for some sort of imminent correction, or maybe even another bear market. The reality is, the market spends most of its time at an all-time high. If you think about it, the stock market's up 3 years out of four, just historically. It's positive 76% of the time. And so the market's going to be at an all-time high more often than not. So I don't know that that necessarily needs to be a scary data point. But then going back to your question, it's still, I think, a good time to potentially shift some from US to international and emerging, not because the US is at an all-time high, but because of the spread in terms of the returns over the last 10 years and what you just highlighted. The S&P, the yield, not that that's ever really a reason to buy the S&P, the yield is about 2, and the yield of foreign markets is 3.5. That's decent. I mean, to get 3.5% yield from an equity index that probably is going to be higher in 10 years than it is now, especially when you can compare it against the US Treasury market, or even just high-grade corporate bonds here, you're getting more to invest in European equities than you are by investing in a 10-year bond based in the States. More than anything, investors have seen negative rates in, let's just keep talking about Europe, so let's talk about Europe. I think people have seen that as a sign that something is wrong, more than uh, just some sort of a trigger. Like, oh, rates are negative, that might actually be good for the companies in Europe who can borrow really cheap, free. And if the stocks are yielding 3.5% on average, maybe that's a reason to get interested. I think you're right. People have shied away from investing there because they've just seen these negative rates as something that's scary. It's never happened before. We don't know what it means. We're going to hold off. We're going to wait until we see some positive signs before we dip our toe in. we're showing a graphic right now that actually demonstrates a very clear correlation between dollar strength or weakness and outperformance of international equities versus US. So it's JP Morgan that put it together. It's a great graphic, and it doesn't necessarily predict that we're on the verge of a change where the dollar is going to go from strengthening to weakening, but that is my contention. I think we're due for that. And it's not that the dollar has been strengthening over the past few years. It's just kind of it's been strong, but staying about where it is versus a basket of other currencies. So whether that's overly complicating things or not, the bottom line is we may be due for a period where the dollar weakens versus other currencies. And if that's the case, that will be good for foreign assets for two reasons. One is that assets are actually just priced in currencies that are appreciating against the dollar. That's just good for obvious reasons. The dollar is no longer a headwind in terms of just what these things are worth. And then number two, particularly in the emerging markets, a lot of companies borrow in US dollars. And if you're paying interest in a bond that is gaining value against your local currency, that can be problematic for your growth because you owe more in local currency in year two than you did in year one. And it kind of becomes a self-fulfilling prophecy. So if these companies have a lot of US dollar denominated debt and the dollar starts weakening, that could actually really be a tailwind. Emerging markets are scary to retail investors, and maybe it's just partly the name. They're emerging. That means that they're not yet. They haven't yet emerged. They're still in the process of emerging, and obviously we refer to the U.S. and most of the European economies and Japan as developed countries. So, we've got more mature banking systems. We've got more stable political regimes. And I think in the emerging markets, you don't have that so much. And so you have the potential for volatility. You've got major political upheaval in a lot of these countries, and you can have shocks in the market where an entire stock market loses 10% overnight. That's still very much possible in the emerging markets. So just to give you a couple names, China is still considered an emerging market, which is a little silly since it's the second largest economy on the planet. Pretty much every Asian economy, with the exception of Japan, is considered an emerging market. So as an investor, if you're looking at emerging markets, I think you need to just assume that it's going to be volatile, but that it's going to provide enhanced returns over a long period of time. As far as catalysts and what could go right, we've mentioned that if the dollar has in fact peaked for the time being, that could provide a tailwind to those markets. And coupled with the fact that you get an enhanced dividend yield and valuations could improve a little bit, and then you also get the benefit of the local currencies moving in your favor. I think that's something that could go right for international and emerging markets. And it's important to highlight also that during the last period where the dollar weakened, it's not like the U.S. did poorly. The U.S. still did well. It was up 100% from 02 to 08 before the financial crisis. So you have the opportunity for positive returns in the U.S. and even better, more positive returns elsewhere. So I'm not necessarily scared by the fact that we're at all-time highs in the U.S., and I'm encouraged by the fact that it looks like global PMIs internationally may have bottomed or be bottoming, and we may have a period of potentially U.S. market exceeding returns from international.